It's time now for today's strategy session. The S&P is nearing 6,000 in the final quarter of the year, but we've got three factors that could threaten to disrupt those gains. We have earnings first off, and then of course the Fed in the background, and that presidential election coming up in just over 2 weeks. Joining us to discuss the path forward here, we've got Liz Ann Sonders, Charles Schwab's chief investment strategist. And Liz Ann, it's great to have you on here. It kind of feels like we're in the eye of the storm, and I'm curious from your perspective, is the kickoff of big tech earnings over the course of the next week here going to lead better vibes than we expect, or is it going to be something perhaps a little bit more sinister?
Well, I don't cover individual stocks in any way, but I think this is an important earnings season broadly, and I think the mega cap tech, the Magnificent Seven, are always crucial within earnings season just because of their dominance from a contribution to index returns perspective. What's interesting about earnings season is as we were going through second quarter reporting season, companies' guidance resulted in analysts basically cutting in half estimates for the third quarter. They didn't really do much to the fourth quarter estimates. And that's been a trend lately where analysts may cut a quarter out during earnings season or change or raise estimates, but they don't go too far out because companies are not providing that same kind of precision around guidance. Now, it's early in the reporting season. So far, so good. Better than average beat rate, better than average percent by which company is beat. And it wouldn't surprise me if the bar yet again got set low, but it's the outlook for fourth quarter and into 2025 that I think is particularly important, especially as it relates to profit margins. The assumptions in 2025 estimates are for record-breaking profit margins, and I think we'll get some color commentary on that this quarter.
Listen, I'm curious, just as we take a step back and figure out where we are right now within the market. Obviously, as we talked about, we had another record-setting week here for the S&P. As we look ahead, and there has been more and more talk about valuation concerns. Are you at all concerned about the current levels, or does this set up support where we are moving forward?
Well, it depends on what component of the market you're talking about. You know, at the index level, the cap-weighted indexes are trading at pretty rich valuations. If you X out some of the high flyers, you're a little bit more reasonable. But the most important thing to point out with regard to valuations is they're a terrible, terrible market timing tool. Not that I think there's such a thing as a great market timing tool, but valuation is not one of them. Valuations can be rich. They can get even richer for an extended period of time. Valuation is almost an indicator of sentiment. And if you did a correlation analysis, if you did a scattergram of starting point valuation measures, say on the S&P 500, and then subsequent one-year returns, there's no relationship. If you go out 10 years, then you start to connect the dots between valuations and returns. But it's a terrible, terrible market timing tool. So stocks are richly valued, but they could get more so.
So Liz, and I'm curious because we've had some analysts come on and investors speaking with us about how valuations are one of the measures that they're looking at to beef up their call that the rotation trade is the winning idea heading into the end of this year. If valuations are not the key thing to be looking at, then what is the bull case for that rotation into small caps moving forward?
Well, I think that there is a valuation case because of that huge differential between the valuations of the mega cap stocks and pretty much the rest of the market. It's not just a valuation argument that sat behind this rotation, which we do think has legs. It's the fact that, using the NASDAQ as an example, NASDAQ at the index level has only had a 13% maximum drawdown this year from mid-July to that early August kind of washout period. But the average member within the NASDAQ has had a 45% maximum drawdown this year. So that bred a lot of opportunity and much more reasonable valuations. And I think that was one of the fundamental drivers of this rotation. And I think it will continue, but it's going to be rotational, meaning it hasn't just been a rotation from the Magnificent Seven to some other segment of the market. You've had the interest-sensitive stocks lead at times. You've moved into more defensive type stocks. So I think rotations where you get sort of diversity of leadership over the short term, that to me is what has legs.